Number 10. Only listen to those you know and trust. In all of his shareholder letters and sporadic interviews, Warren Buffett stresses the significance of only funding management teams that are dependable and capable. Simply said, Warren Buffett chooses his company partners and managers with great care.
Three things when we hire people. We look for intelligence, we look for initiative or energy, and we look for integrity.
For many years to come, their decisions might make or break an investment. Warren Buffett is obviously much more connected than any of us, which undoubtedly aids in his ability to identify the top management teams in a given business. When it comes to choosing our investments and managing our portfolios, we can surely influence who we listen to, even though we lack the resources to truly assess the moral character and managerial ability of a public company's CEO. The financial sector is full of both good and terrible people. Unfortunately, a lot of people are aware that they can take advantage of investors' inflated expectations, as well as their feelings of fear and greed, to make quick money. Many talking heads and financial gurus are in the business of grabbing attention to sell more advertising space, attracting new subscribers with dramatic claims, or persuading investors to make trades to earn a fee. None of these actions are advantageous to individual investors, and self-described experts are typically no more accurate at forecasting the future than we are. Simply acting the part of Mr. Confident will serve their own goals. Actually, by most measures, the experts giving guidance are quite mediocre. Number 9. Low-cost index funds are sensible for most investors. Did you know that the majority of investors fall short of the market, frequently by a large margin? We undermine our performance in a variety of ways, such as attempting to time the market, taking unwarranted risks, trading emotionally, straying outside of our areas of expertise, and more.
Investors behave in very human ways, which is they get very excited during bull markets and they look in the rearview mirror and they say, I made money last year, I'm going to make more money this year, so this time I'll borrow, or the neighbor says, I wasn't in last year when that neighbor was dumber than I made a lot of money, so I'm going to go in this year. So they're always looking in the rearview mirror. And when they look in the rearview mirror and they see a lot of money having been made in the last few years, they plow in and they just push and push and push on prices. And when they look in the rearview mirror and they see no money having been made, they just say, this is a lousy place to be. So they don't care what's going on.
And to make matters worse, a lot of actively managed investment funds tack on a lot of fees, which reduces returns and dividend income. Despite being regarded as one of history's most successful stock pickers, Warren Buffett supports passive index funds in his 2013 shareholder letter. Many investors should think about low-cost passive indexing, especially if they are not concerned about producing consistent dividend income. ETF dividends tend to be lumpy and more susceptible to cuts during bear markets. The majority of stock pickers fall short of producing results that justify their increased costs. Number 8. The best moves are usually boring. Stock market investing is not a quick way to become wealthy. If anything, I think the stock market is best suited for gradually increasing our current capital over an extended period. The goal of investing is not to have fun, and dividend growth investment in particular is a cautious approach. It is frequently preferable to invest in businesses that have already established their value rather than trying to identify the next big winner in a developing market.
Use cigar butts of stocks. And the cigar butt approach to buying stocks is that you walk down the street and you're looking around for cigar butts and you find this, on the street, this terrible looking, soggy, ugly looking cigar, one puff left in it. But you pick it up and you get your one puff. It's disgusting, you throw it away, but it's free. I mean, it's cheap. And then you look around for another soggy, one puff cigarette. Well, that's what I did for years. It's a mistake. Although you can make money doing it, but you can't make it with big money. It's so much easier just to buy wonderful businesses. So now I would rather buy a wonderful business at a fair price than a fair business at a wonderful price.
After all, the objective is to identify high-caliber companies whose value will increase over a long period. The return on our portfolio will take care of itself if we do this correctly. Snacks, drinks, toothpaste, medications, convenience stores, and other basic goods and services are offered by many businesses that can boast long and prosperous corporate histories. Although not the most thrilling industry, leaders in an industry are frequently protected by a moderate rate of change. The Dividend Aristocrats Index and Dividend Kings list both include numerous companies that have benefited from this phenomenon. There is no need to try to impress someone with our investments or try to be a hero. Boring can also be lovely.
So you might not swing for 6 months.
You might not swing for 2 years.
Isn't that boring?
It would bore most people, and certainly boredom is a problem with most professional money managers. If they try to sit out an inning or two, not only do they get somewhat antsy, but their clients are start yelling, "Swing, you bum," from the stands, and that's very tough for people to do.
Number 7. Know the difference between price and value. We always have stock prices thrust at us. Investors frequently become fixated on ticker quotes that are displayed on screens for whatever reason. But stock prices naturally fluctuate more than core corporate fundamentals do in most cases. In other words, there may be times in the market when stock prices have little relationship to a company's longer-term prospects. Because investors were eager to liquidate all companies during the financial crisis, regardless of their commercial viability or long-term earnings potential, many bargains became available. In other words, the stock price of a corporation was temporarily divorced from the value of its underlying operations. We need to take Warren Buffett's suggestion to acquire quality when it is marked down in price as long-term investors.
If you're making a good investment in a security, it shouldn't bother you if they close down the stock market for 5 years. All the ticker tells me is the price. And I can look at the price occasionally to see whether the price is outlandishly cheap or outlandishly high. But prices don't tell me anything about a business. Business figures themselves tell me something about a business, but the price of a stock doesn't tell me anything about a business. I would rather value a stock or a business first and not even know the price, so that I'm not influenced by the price in establishing my valuation, and then look at the price later to see whether it's way out of line with what my value is.
Even while stock prices fluctuate in response to investor sentiment, this does not impact how much cash a firm will generate in the future. While there is always some dispute on a company's potential profit stream, it is typically much less than the volatility of the stock price. Investors must make a distinction between price and value, focusing their attention on high-quality companies that are currently trading at the most competitive prices. Number 6. Investing isn't rocket science, but there is no easy button. One of the biggest misunderstandings about investing is that only experienced stock pickers can make profitable decisions. Raw intelligence, on the other hand, is possibly one of the least reliable indicators of investment success. It doesn't take a genius to emulate Warren Buffett's financial approach, yet beating the market and avoiding behavioral blunders regularly is extremely challenging for everyone. Investors must also remember that there is no secret method, rulebook, or easy button that can produce outcomes that outperform the market. It doesn't and never will exist. In my opinion, anyone who claims to have such a system to attract customers is either extremely ignorant or no better than a snake oil seller. Watch out for self-described gurus who try to offer you a hands-off, rule-based approach to investing. The proprietor most certainly wouldn't need to sell books or subscriptions if such a system genuinely existed. Adhering to a broad set of investment rules is acceptable, but investing is still a challenging skill that necessitates thought and shouldn't be perceived as simple. Number 5. Most news is noise, not news. Every day, a ton of financial news arrives in my mailbox. Even though I am known for reading headlines, I ignore practically all information that is given to me. According to the 80-20 rule, about 20% of an event's causes are responsible for 80% of its results. I contend that the 99-1 rule applies more to financial news, which states that only 1% of the financial news we read should be responsible for 99% of the investment decisions we make. The majority of TV news headlines and discussions aim to create excitement and stir up our feelings, so we'll do anything. The businesses that I recommend to invest in have so far stood the test of time. Many have been in operation for more than 100 years and have encountered almost every unforeseen difficulty imaginable. Imagine how many articles of doom and gloom were published during their business careers. They are still standing, though. Does it really matter if Coca-Cola Cola's earnings came in 4% behind expectations? Given that Johnson & Johnson's stock has dropped 10% since my initial purchase, should I liquidate my holdings? Should I sell my shares of ExxonMobil since declining oil prices are reducing its profits? The answer to these questions is almost always emphatically no, yet when these issues develop, stock values may change considerably. Financial news sources must expose these problems to stay in business. Number 4. Diversification can be dangerous. I believe that when individual investors purchase between 20 and 60 equities across several industries, they will reap the majority of the rewards of diversification. However, a portfolio of many mutual funds includes hundreds of stocks. The exact reverse is true with Warren Buffett. Buffett's highest investment in 1960 was a staggering 35% of his total portfolio. Simply said, Warren Buffett understands that the market rarely presents outstanding firms at affordable prices and invests with confidence in his finest ideas. On the other extreme, some investors over-diversify their portfolios out of misplaced fear or ignorance. It is practically hard for an investor to stay current on news that affects their companies when they own 100 equities. A portfolio with excessive diversification is also more likely to be invested in several subpar companies, which will lessen the impact of its high-quality holdings. Do you own numerous stocks? If the number is higher than 60, you should definitely think about trimming your assets to concentrate on your highest quality investments. Number 3. When you buy a stock, plan to hold it forever. How long should a high-caliber firm be held after being bought at a fair price? Warren Buffett firmly believes in the buy and hold philosophy. He has been in some of his roles for many years. Why? One issue is that it's challenging to locate good companies with a promising long-term future. Buffett runs a concentrated portfolio for this reason. High returns are also earned by high-quality firms, and their value grows over time. Time is a wonderful business friend, as Warren Buffett once said.
Stocks sell at silly prices from time to time. Most stocks at one time or another sell at very silly prices. And it doesn't take a high IQ to figure out that they're cheap, but it does take a temperament that's willing to step up and actually act. And you have to be able to ignore what other people are saying and simply look at the facts and decide, is this stock which is selling at X worth 2X?
Only patient investors are rewarded when fundamentals eventually affect a stock's price, which can take years. The final factor that undermines investment returns is trading activity. Taxes and trading commissions are two ways that frequent stock trading reduces returns. We would be better off to purchase right and sit tight instead. Number 2. Never compromise on business quality. It's quite simple to say no to complex businesses and industries, but it's much harder to find high-quality firms. Over the past 50 years, Warren Buffett's investing strategy has changed, now concentrating almost entirely on purchasing high-quality businesses with excellent long-term growth prospects. The fact that Berkshire Hathaway's name is derived from one of Buffett's worst bets may surprise some investors. Buffett was persuaded to purchase Berkshire because it appeared to be a good deal. After all, the company made textiles. He thought that even if a company's long-term performance remained dismal if you bought a stock at a sufficiently low price, there would typically be some unexpected good news that would allow you to sell the position for a respectable profit. Warren Buffett's opinion on cigar butt investing has altered as he has gained more expertise. He claimed that taking such a strategy to buy firms is unwise unless you are a liquidator. Likely the initial cheap pricing was not quite such a steal after all. In a challenging industry, once one issue is resolved, another one inevitably arises. These businesses typically have modest returns, thus depreciating the value of the initial investment. Number 1. Never invest in a business you cannot understand. Warren Buffett.
I have an old-fashioned belief that I should expect to make money in things that I understand. And when I say understand, I don't mean understand, what the product does or anything like that. I mean understand what the economics of the business are likely to look like 10 years from now or 20 years from now.
Getting entangled in overly complex investments is one of the simplest ways to make a mistake that could have been avoided. Many of us have worked in a small number of industries throughout our entire lives. We probably have a good understanding of how these specific marketplaces operate and who the top companies are in the industry. The vast majority of publicly traded companies, however, operate in sectors where we have little to no experience. This does not exclude us from making financial investments in these market segments, but we should proceed cautiously. The vast majority of corporations run operations that are too complex for us to easily understand. Let us admit that we cannot anticipate the success of a biotechnology company's medication pipeline, the upcoming key adolescent fashion fad, or the upcoming scientific discovery that will spur semiconductor chip demand. Although they are undoubtedly unpredictable, these kinds of complex challenges have a significant impact on the earnings produced by numerous market organizations. Within 10 minutes, if I haven't reasonably figured out how a business produces money and the key factors affecting its industry, I go on to the next one. I estimate that only a small number of the 10,000 publicly listed companies in existence adhere to my own criteria for business simplicity. Never invest in a concept that you can't draw with a crayon, according to Peter Lynch. By sticking inside our realm of expertise and taking up a Crayola, we can steer clear of a lot of blunders.